Hey guys, Akil Stokes here and welcome back to another Weekend Trading Edge video, the series where I take you around the markets and share a few of the best trading ideas for the week ahead and drop some serious knowledge bombs along the way. Today I've got 7 brand new trading opportunities across multiple markets, and more importantly, we're breaking down the why behind those opportunities. We're going to talk about the danger of forcing trades, regular divergence, hidden divergence, advanced patterns, classic patterns, candlestick analysis, supply and demand, how to identify loss of momentum, and much more. Oh, and make sure you stick around until the very end because I've got a very special announcement about something that's going to happen on Tuesday that you'll definitely want to take advantage of. All right, load up your charts, open that notes app, smash that like and subscribe button if you haven't already, and let's hop in. We're gonna head to the Aussie Canada, and I've got a bunch of cool lessons for you here. And first and foremost, what's interesting about the Aussie Canada is that I've traded the Aussie Canada probably for about close to a decade now, right? It was the last pair added to my portfolio. And I swear I have never taken a trade on this pair that wasn't a pattern formation. We talk about pairs having different personalities. Some like the trend, some like to consolidate. Well, this one usually all it does is consolidate. But recently, right, we've been pretty directional. So it'll be interesting to see if I can actually get my first non-pattern trade on the Aussie Canada. But Aussie Canada is at a very interesting point. So first and foremost, let's do the little trick that I taught you that everyone should be able to do. Let's put a horizontal line on the highs. Let's not get suckered into being like, oh my gosh, we broke out of this channel, we got to go higher. And let's actually take a look at where we are at. And if we look to the left, we will see that once again, we have ran into another level of previous structure. We can go back even further if you want, but just look at the ebbs and flows or the times that price action hit this level. Right there, we near missed it right there, but it's in that zone. We came back, consolidated there, we consolidated here, we consolidated there. We're at a nice little ice zone here, a previous level of structure, support, and resistance. So we're definitely not in the middle of no man's land here on Aussie Canada. And knowing that we're at support, or resistance, excuse me, is gonna be helpful in this situation because the particular pattern that we're going to talk about is one that I love, but I only love it when it's at a certain level. So what is this pattern that Akil loves so much? Well, it is going to be the rising wedge. And the rising wedge is a loss of momentum pattern. And again, I love using the ball reference. The camera's not up today, but I can imagine myself throwing a ball in the air. If you were to throw a ball, any type of ball, a round ball, a soccer ball, a football, a basketball, whatever it is, into the air, right? The period where it has the most momentum is after it kind of leaves your hand and starts working its way up. And it goes up at a very steep angle because there's a lot of force behind it. Then, I can easily just draw this on a chart for you guys. There we go. Boom, leaving your hand, it goes up. At some point, that momentum starts to slow. It starts to run out of steam. It starts to bend off before it starts crashing back down to earth. This is the same way I look at these rising channels or falling channels, right? Price action came up at a pretty steep slope, right? Right here. And then you can see that all of a sudden, instead of just going straight up, it started ebbing and flowing a little more, right? That's going to be that loss of momentum. And that loss of momentum happens for a few reasons. The main 2 reasons are going to be the buying pressure has slowed down, right? As something gets more expensive, less people buy. I always like, if you want to visualize kind of the market movement, buying and selling pressure, supply and demand, I think one of the best ways you can visualize it as being at like an auction, right? Where if you've ever been to an auction, there's an auctioneer at the top and they say, hey, I've got item number 452 for sale. And we're going to start the bidding at $5, right? If $5 is very cheap, everyone's holding up their hand and doing their little signal thing, right? Then it goes to $10 and people are still excited. There's still a lot of momentum because they still find it to be cheap. But eventually, price gets to a point where it's not as cheap as it used to be. Maybe it gets up to $50, and then you got some people that are just like, oh yeah, I still evaluate at $50. But then you got other people that are like, maybe not so much, right? So you can see there's less hands going up. There's less kind of interest in the market. So that's one, there's less buying interest as the asset gets more expensive. And then 2, there's more selling interest because as the asset gets more expensive, For a seller, more expensive is cheaper, so it becomes a bargain buy for them. I know that's confusing, but if you're familiar with the Forex market, it makes perfect sense. So that's what we have here. Now, in last weekend's Trading Edge video, I believe we talked about hidden divergence, which is that evil type of divergence that you should never look at because it's going to confuse you if you're new, but it's also very helpful as far as like trend continuation goes. This is going to be an example of regular divergence. And what I want to do is I want to pull up my RSI, and I want you to take a look at the differences between the RSI and price action, right? So the RSI should be, right, should in my air quotes, should be mimicking price action, right? So as price action comes down, our RSI goes down. All right, as price action kind of ebbs and flows up, our RSI ebbs and flows up. As price action kind of goes sideways here, we start to get a little bit of divergence right there. And then we explode up again and price action explodes up, right? So we're putting in higher highs here with price, and we're putting in higher highs here with the RSI, right? It's all good, baby, right? But then look what happens now. Price action retraces, boom, boom, boom. But our RSI, boom, wait a minute, lower, boom, wait a minute, right? This is going to be called divergence or regular divergence. So where hidden divergence last week was a good sign for a trend continuation trader, this is a good sign for a counter trend trader. So we have a few things lining up. Going back to the CTS lesson we spoke about in the previous podcast, we have a rising channel, if that's how you spell channel, two N's. There we go, channel, maybe. Oh no, now I'm brain farting. Someone correct me. Channel, no, sorry, I shouldn't be doing this, not professional. There we go. One of the track girls that I coaches, her name is Chanel, and she's got a birthday coming up, and I just did a post for her, and I made sure not to put two N's in it, so it wasn't happy birthday channel, and now I'm all weirded out for it. But we have a rising channel, which is a sign, a good bearish sign. So let's put a bear there for you. We've got price action at previous structure, right? Which is another bearish sign. So let's put another bear in there. And then we have divergence, right? RSI divergence, RSI divergence. And the RSI stands for the relative strength index for you guys that may be unfamiliar. It's a momentum indicator pretty much. So we're going through our checklist and we've got everything aligning. And that's exactly what we're looking for as traders. Now, here's the hard part. Rising channels are typically hard to trade for me because the thing is, you never know when they're going to roll over, right? Typically you would say, or one entry technique if you're aggressive is you wait for a lower low, lower close. But remember, the nature of this channel is to kind of retrace a little bit and then push higher, even though it's still valid. So I'll give you two ways to trade it. One way is to try to pick the point where it runs into structure, which is where we're at right now, and then look for that lower low, lower close right there. Then you maybe have a stop loss right above, and then if it doesn't work out, just look to re-enter again. Two, if you're a trend line trader, which I am not, right? So we can always get into this debate like how to draw. I would draw my trend line like this if I want to be technical with it because it connects the dots, but that's not really the real flow of the pattern. So I'll tell you what, if you are a trend line trader, because I am not, so I try not to give advice on trend lines because I don't like to give advice on things I don't actually do. But if you are a trend line trader, we had this debate in our Q&A session. Can you type in below in the comment section, how do you draw in your trend lines? Do you literally connect one dot to the other dot? Or do you take a more artsy approach and look at like the natural flow of the pattern? And this is a serious question. I'm not going to jump in and like be like, you're an idiot. I'm just genuinely curious how trend line traders do it. But one way to trade it would be to wait for the violation of that trend line. Regardless, when it comes to the rising channel, I would only look for a move back down to the base of the channel. So I'm not looking for any type of move all the way down here, just a return to when we started losing momentum. So yeah, pretty decent opportunity here on the Aussie Canada, and it's not an advanced pattern formation, which is weird. Now going from a pattern that I love but don't trade unless it's in a very specific location to a pattern that I love and I can trade. We're going to take a look at gold, everyone's favorite commodity right now. Maybe silver is everyone's favorite, but gold and silver, everyone's favorite commodities right now. And we're going to take a look at an ascending triangle. Now, earlier this week, I shared with you a video and we took a look at Coke, right? Coca-Cola. Well, got to be very careful of saying Coke, especially in a trading video, because some of you guys are like, yeah, Coke, right? And you see the notes are still on our chart right here. But we had a nice ascending triangle here on Coca-Cola that broke out. You can see that we had equal highs and we had higher lows, and boom, we broke out to the upside, which is exactly what we were supposed to do. Yeah, Coke. Gold, it's going to be a little bit different. It's a great example how you can have the same pattern kind of form in a different way, where your traditional rising or ascending triangle, comes after a directional move. Then we kind of base out and do something like this and break to the upside. This one comes after a move in the opposite direction. As you go down to gold on the 4-hour, you can see the prevailing move before this was our big correction on gold. And then we came up. We retraced. We had a failed cipher in here somewhere, right in a lower time frame, right in this area. We put in another high here, and then we retraced, and we still have that series of low, higher low, higher low, high, equal high. So this trend line at the top, or this horizontal level of resistance at the top, is going to be a key decision point for me, meaning that this is an area in which if price action can violate it, break and close above, I would fully expect a kaboom back up to retest gold. And remember, we still have that bat pattern. I think it's a bat pattern. It was Bat or Gartley, one of the two. We still have that pattern. Yeah, that bat pattern setting up on gold as well. So this could be one where, obviously, if you're not a pattern trader, you wouldn't want to trade the pattern. But if you're someone that's interested in doing one of those stop and reverse things where you trade it up to here and then you cash out and take your money and trade it down to there, that's an option as well. So a pretty cool setup here on gold. Again, I personally like to wait for the break and close above. That way I have, what's the word I'm looking for? Brain farting, been sick all week, so my head's still blurry. Confirmation of the breakout. Well, 3 ways to trade it. Let's just go back to that. One would be wait for the break and close above. You have confirmation of the breakout, and then you can just be aggressive and trade it right after that. 2, you can wait for the break and close above and then look for a little bit of relief, a little bit of pullback to get a little cheaper price, and then look to trade that next extension up. Or 3, if you're super aggressive, right? Establish a position. We're a little bit off the lows right here, but maybe we'll do one more test. Maybe we'll come up and test again like that. Establish a position at these lows and try to get involved before the breakout. This is the most riskiest option because you have no idea if the breakout is actually going to break out or not. You have no hidden clues. But I would tell you, if you can position yourself here, you have a clear level of where your stops need to be, right below this level, because we should not put in a lower low if this ascending triangle is going to hold true. And that gives you a very nice move up to either that bat pattern or to the highs of gold or to beyond if you are a gold investor. So nice opportunity here on gold. Once again, you're welcome. Now, since we're on gold, we might as well go to silver. And let's talk about what's happening on silver. Silver is consolidating as well after that double bottom that we put in, that failed double bottom that we put in, a couple weeks ago. And silver has an interesting pattern formation happening. We're nowhere near it yet, but just look for the future. So let's ask ourselves the question here. Where is the most relevant retracement in silver? If I just draw this out from here to here to here, what level, just play along. I know you can't answer because you're watching this after it's already recorded. But what is the most relevant level as far as like a decision point on silver? Would you guys say it's point A right here or point B right there? Let's make it a little quiz, right? Type it in the comment section below right now. Don't cheat and wait till I give you the answer. Type it in right now. That way I can get kind of an idea of who says what. All right, I hope you typed it in. I hope you were being honest. There's no one cares if you're right or wrong. This is all fun. This is all part of the educational experience. So don't be ego hurt if you got it right or wrong, or you're worried about what other people are going to say about you. Like, throw that out the water, right? But the point that's going to be the most important for me is going to be this level right here. And just like with gold, if we can violate that level, I would expect a move higher. With that being said, I do see a level on silver where it would not surprise me if we saw a little bit of a pause, because we had a little bit of a pause before. Now, I know this looks like a straight move high to low, but in fact, we had a little bit of a pullback in here, right? So this level is a level that stands out for me as a place that the market respected and that the market may respect again in the future. And why did it respect this level? Well, what's magical about this level? Well, maybe I'll draw a horizontal line on right in the middle and you tell me something that stands out to you psychologically, perhaps. Yeah, that good old Ben Franklin. That's 100, by the way. I know it because my wallet's full of them. It's the smallest bill I own because of all those trading profits and whatnot. Anyway, so I would expect the market to give a brief pause, maybe have a think at that level as all the headlines, oh, silver's at 100 again, blah, 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 blah. Now, going back to what we have here on silver, if we look at this as our starting point, our X leg, and we look at this as being our swing low, if I take my Fibonacci retracement from swing high to swing low, you're going to see that we come into a 786 Fibonacci retracement. Let me just want to measure that in again to make sure I'm seeing this correctly. I'll anchor it on there as well, which I hate doing because I forget to take it off and it makes my thing all weird. But let's measure that in, and we can see that 186. Sorry, see, the anchor thing made it all weird. There we go. We can see that price action indeed hit our 786. So that puts me on alert for a butterfly pattern. As I mentioned earlier in the video, I like to draw my butterflies by taking a Fibonacci extension, inverting it, so doing it backwards from the swing low to the swing high, and I like to look for that 127 Fibonacci extension. And yeah, you see it. You see it. It comes right at that Benjamin Franklin. So, butterfly traders, this is a decent place to look to get involved. One of the issues we have with butterfly traders, and this is I'm still looking for an answer for this. So if you want to comment below and how you trade it as well, feel free. But one of the questions I always have is like, how do you know where to put your stop loss if there is no structure? And for this situation, you actually have a little bit of structure right above this box. So you can actually, if you are a butterfly trader in need of structure, you actually have a nice place you can put stops above. Now, understand that the butterfly pattern is just a relief pattern. It is very similar to the the Aussie Canada trade we looked at, right? Where as price action breaks out of the X leg, it is a break above a previous level of resistance. So there's lots of momentum, right, happening there. The ball is leaving the hand. And then we get to the butterfly completion point, and we expect that's where the momentum starts to die down. Again, less buyers are interested because it's more expensive. More sellers are interested because it's more cheap for them. And we see a little bit of a relief, so something like this. That is our expectation for the butterfly pattern. It isn't to sell this thing all the way back down to 65 bucks or whatever it may be. We just want a move back to the X leg, maybe beyond, a little bit more down to the B leg like that. And that's all we want out of it. So it's not a full-blown bearish reversal in silver. It's just a quick little counter trend trade. And yes, if you are asking, we do have a potential head and shoulders here as well. Same situation as that pair I mentioned earlier, pound dollar, I think it was. Again, my been sick all week. My brain is cloudy, so I'm very forgetful. But left shoulder, neckline, head, right neckline, right shoulder being put in right now. Your slanted neckline puts it like that. Your horizontal neckline puts it like that. So again, what's needed is either a violation of this if you're slanty, or a violation of that if you're horizontally. Yeah. So while we're at the halfway point of this video, I want to remind you guys, if you ever have any questions about trading computers, what needs to be put in the computer or what type of computer you may need if you want to be a trader, here's what I recommend doing. Scan this QR code or check the link in the description below and check out this free trading computer builders or buyers guide. Again, it is a bunch of information, is 100% free. I've personally used easy trading computers to build both of my systems. They have the first one I had for 10 years. The second one, I think I'm on year 3 right now. And I use this guide to kind of figure out what I wanted to get. And then because I know nothing about computers, I just had them build it for me instead of building it myself. But I don't do a lot of promotion on this channel at all because I only try to promote things that I actually use and value. And this is one of those things. So scan that QR code, check out the computer guide, and get all your questions answered. So we're going to kick things off here on the pound dollar, and this is going to be a perfect example of why perspective matters. When we look at this isolated time period from last summer till now, a lot of you guys would clearly say that we have a breakout. We can identify a previous level of structure highs right here. We can see that we have a clear break and close above structure. And because you guys join me each and every week for the Weekend Trading Edge video, you know my rules on structure. If price action breaks and closes above, we call it a violation structure, then we can predict that price is likely to go higher. If price is likely to go higher, how are we likely to get there? Well, one of the methods that Akil uses is to wait for the pullback and then look for the extension higher. So we can easily look at this setup and say, man, perfect trend continuation trade to the bull side. Let's get in. But something that my mentors always told me, and it's ingrained in my head, which is why I pass it forward to you guys, is to look left because structure leaves clues. And something I like to do is this. I like to draw a horizontal line right at the highs of wherever our previous or current level is at. And I just like to kind of look back through history and see if we are indeed in a clear sailing situation or if there might be something lurking up here. And as we go back to the beautiful year of 2021, maybe not so beautiful if it was just after July 2021, I guess we were kind of out of COVID maybe. Anyway, you can see that we actually aren't in the clear. We are at another level of structure. And live remembers, you guys remember me saying that we should expect choppy waters ahead because as price action ebbed and flowed down from our highs up here around, what is this, $1.42, we created multiple overlapping levels of structure, which make it very hard to predict extensions because each of those higher levels of structure becomes another level of resistance that price would then have to break through. So one, that's going to put a big hold on our trend continuation trade. 2, seeing how we tested and held structure once again, this is going to continue our consolidation type of analysis. Now, I just put out a podcast yesterday or 2 days ago, whenever the last one came out or whenever this video comes out, I suppose, talking or answering a question from a trader about having multiple trading strategies and jumping from one strategy when the market conditions are doing this and then jumping to the other strategy when the market conditions are doing that. And I would advise that all of you guys listen to that podcast. It's really good at addressing this fully. But to kind of summarize things, I said that I think it's a bad idea to try to time the market and say that I'm going to do one thing when the market does this, then switch to another thing. Because fact of the matter is, we don't know that we're trending until we've already been trending. We don't know that we're consolidating until we're already consolidating. So you're always going to be one step behind. Rather, what I've done in my trading career is I've implemented different strategies or grew my trading style. So I have different strategies. Some of them take advantage of consolidation. Some of them take advantage of directional markets. And a good example is going to be right here on the pound dollar, of how advanced pattern formations take advantage of these markets, right? We've had 3 Cyphers, at least that I took that I remember, in this really short period. I'll draw them out kind of roughly for you, but we had one right here, swing high to swing low, X to A to B, B to C and a CD completion down here, which was a nice little winner. We'll give that the $ face. Hooray! That took us right into another cipher, right? Some of you guys remember these back-to-backs, X to A to B, B to C, C to D up here. This gave us another winner. Hooray! We then had a loser, right? I'm not here to show you that we win all the time. We do lose as well. We had an X to A to B, B to C, and a C to D right down here that ended up losing. Where's my mad face? Grr. And we also almost had a bigger one as well. This one never got triggered, but it would have been an X to A to B, B to C, and I believe the CD completion was a little bit, oops, sorry about that, a little bit lower here down there, which would have been a nice win, but we never actually got there. So you can see as the market consolidates, advanced pattern formations are a good way to take advantage of that. 3 trades, 2 wins, 1 loss. We'll take that all day. Now, what we have happening here within this little consolidative area is actually going to be 2 patterns potentially that complete at the same area. But I'm also going to tell you why it's important not to force a trade. So let's go down to the 4-hour and let's take a look at this real quick. The first pattern I want to concentrate on is going to be what's called a butterfly pattern. We're going to start with my X leg right up here. This is going to be my starting point, as it is with any of the other patterns that I trade. And our initial swing high to swing low, that is going to be my X to my A leg. I'm then going to bring my Fibonacci retracement on from that swing high to my swing low. And based on what Fibonacci retracement level is hit, that's going to tell me which advanced pattern formation to expect. We come to the 786, which means I'm on alert for a butterfly pattern. And for how I trade butterflies, what I'd look for is I'd look for a completion point at the 127 inversion. So taking my Fibonacci extension tool and drawing it backwards from our A leg right here back up to our X leg right there. And I'm going to look for a move to our 127 inversion. So all in all, it's going to look something like this. Swing high to swing low, X to A to B right here, B to C, and then a C, D completion right up in that zone. Now, this is where things can get confusing for some, but not confusing if you have a very simple rule, which I'll tell you about at the very end. Not the end of the video, the very end of this analysis here. So if I look at this for a potential cipher pattern, I'm going to show you how I would measure this out. I would take my swing high, my X leg starting right there, and this would be my swing high to swing low, right? My X to my A leg. I then want to take my Fibonacci retracement tool and I want to drag it from my high of my X to my low of my A. I'll erase some of the other stuff here. Let me see if I can get rid of some of these fibs for you guys. There we go. I'll erase some of that other stuff. Yep, and you can see that we clearly hit a 3D2, putting me on cipher alert. Now, for the C part of my cipher, which is going to be down here, all right, I want to take mine. Let me just delete all this real quick. Sorry, guys. I'm used to seeing it all dirty, but I'll draw it on. I want to take my Fibonacci extension tool from that X leg down to my A leg and back up. And one of the rules for my cipher pattern is that our C leg cannot close below the 1414. You can see the straight line right here represents my 1414. And unfortunately, this red candle right here closes below. So right then and there, as I'm going through my checklist to make sure I'm disciplined and nothing slips through the cracks, I'm looking at this saying, ooh, X to A, that looks good, perfect, boom. Ooh, A to B, that looks good, perfect, boom. Step 3, ooh, B to C, that, oh man, right? But the trade is done. The trade is done. So right now I would tear it up, crumple it up, throw it in the trash, whatever you would do. But here's what I see traders do sometimes. They see this and they say, ah, man, Akil, I really want to see a cipher. It thinks that this is invalid. But what if instead of using my X to A leg from here to here, what if I decided to do it from here instead? If I remeasure that, let's see what this does here, and I take it up there, and I move this up here, and oh, look at that. All of a sudden, that 1414 is not violated, which gives me a valid C leg, which sets me up for a potential cipher pattern that would be right here as soon as I measure out where that 786 Fibonacci retracement is. Boom, look at that, I nailed it. Look at that, hats off to me. And that would also put me, I believe, at the same location, look at that, as the butterfly that you spoke about earlier. This is perfect. Cypher, bearish, butterfly, bearish, same level, boom. But the question I would have for you is, did you actually see this as the starting point for your cipher pattern? Or did you only change it from here to here because this part didn't work? Now, if you originally saw this level, which I think is fine if you originally saw this level, right? This is not a bad level to shoot for. If you saw this first and foremost, meaning that when you took a look at this chart, your eyes were glued to that level and that's the first place that you started drawing out your X to A from, I think you're perfectly fine. This is a valid cipher pattern. Go for it. However, if you initially saw this part and went through the whole process, realized it was invalid down here, and only adjusted it because you knew that is what would be needed to make it work, then that is going to be called forcing a trade, and that is a big no-no. And unfortunately, that is something that I see a lot of traders do. Now, this is a simple version of it. I've seen traders do some wild stuff where they start legs in the middle of space just to make the Fibonacci's work. And as a trader, you just can't do that. So cool situation here. If you have it as a cipher and a butterfly, you got two patterns in the same area, which is always nice while the market is in a period of consolidation. But if you force that cipher, then, right, you gotta let it be invalid. Now, real quick, while we're here, just want to talk about one more price action thing. This is not really on my radar because the way I trade it, I don't really see a lot of room for potential. But I know some of you, right, some of you regulars here are shouting at your computer, Akil, what about the head and shoulders? Well, you are 100%, yeah, 100% correct. There is a head and shoulders here. We have a directional move. This is going to be our left shoulder. I'm not drawing it. I'm drawing it in the middle of the space so you can kind of see it, right? This is going to be our neckline right here. This is going to be our head, our extension. This is going to be our second neckline right here, and we're currently putting in a right shoulder. Now, this is an interesting situation, and just as you need to have rules about are you forcing a pattern or not, as a head and shoulders trader, and I tell this to all our traders that I work with, you need to know how do you trade this classic reversal pattern. Meaning, are you someone that trades it using a slanted neckline, so using a trend line for your neckline, connecting the highest shoulder one, or neck one, excuse me, and the highest neck two? Or are you a horizontal support and resistance trader who takes whatever the highest point of that neckline is and needs this level for a break? And in many situations, it's not going to make too much of a difference, but in this one, it would make a massive difference, because if price action were to break out and close above this level, this would validate your head and shoulders pattern, which would mean you would look for longs for the slanted neckline trader. However, the horizontal neckline trader, they would need a violation of this level. So you can see it does make a big difference, because one trader can have a pure validation and a valid head and shoulders, while another trader may still be waiting. Now, real quick, if you're asking, why does Akil have no interest in this? Well, before I say that, one, yes, you do need to be consistent with this, right? So in case you're asking yourself the question like, well, what if I do the trend line sometimes and the horizontal one the other time? My answer is, well, how would you know when to use one and when to use the other? And the answer is simple, right? You would use one when it best suits your interests. You would use the other when that best suits your interests. That's the thing about trading. When we give ourselves freedom, we often will pick the thing that we ultimately want to do. It's kind of like, right, the whole algorithm on the internet, right? If you believe in something, right, you will search the internet until you find something that supports what you believe in, and you'll be like, I told you Google said it was right. And there's no consistency in that. So you got to make a decision. Are you going to consistently trade trend line? Or are you going to consistently trade horizontal line? I personally don't care what you do. I personally don't care about anything you do in your trading aside from like having a rules-based trading plan and following your rules in a disciplined fashion. But as far as like the technicals of how you trade, that's completely up to you, and it should be flexible. But you do need to be consistent in how you do it. Now, why this is not interesting to me is because I trade horizontal necklines, right? So this yellow line is what I would need to be violated in order for the pattern to be validated. Look at that, I nailed it. I was scared there. And if we were to violate/validate this pattern, my next question is, okay, well, I know we're likely to go higher. Where are we likely to go higher to? I honestly wouldn't project us to go higher past this little rejection zone right here. So it's a cool looking setup and all, but it just doesn't have enough meat on the bone for me to be interested in. Now, speaking of questions answered, one of the questions that I got this week when I asked you guys, is there anything you want to take a look at in the Trading Edge video, was, Akil, can you find us a situation where you can combine advanced pattern formations and continuation type of trades? And believe it or not, but I actually found one. It's going to be here on the pound dollar. So let's take a look through our IPDE process. That is a 4-step process, if you guys are new, that we follow to have consistency in our trading, IPDE, because you know my magical formula to trading success: consistent analysis plus consistent execution equals consistent results. And essentially that means that if you analyze the market the same way and you take the trades that you're supposed to take and don't do anything dumb to mess it up, you should expect to get the results that your back testing said you should get, or at least close to. There's always gonna be a little bit less, but close to. So let's start off by identifying what price action has done. Where is price action trading at? And once again, we're going to my favorite tool, the horizontal line tool. And I wanna look left because structure leaves clues. I wanna ask myself, what has price action done? Well, it looks like price action has violated a previous level of structure right here. We're going to need to go back and double check that. And if we did, we are at a previous level of, we have some consolidation down here, but we'll kind of look at let's look at this psychological number right here, $1.90 as being the next level that we could potentially go to within that consolidation. So scroll back to reality and let's make sure we broke and closed below. Okay, look at that. Cannot be debated. We had a lower low, lower close. So having that lower low, lower close, right? Identifying that L3C allows me to make the prediction that price is likely to go lower. Now, I kind of jumped the gun already because I've been doing this for the last almost 20 years of my life, but there's 3 steps to that prediction process. One is if I identify a lower low, lower close, then what direction is the price likely to go in? Lower. If price is likely to go lower, then where are we likely to go to next? This yellow line, $1.90. Again, that's the part that I kind of jumped the gun on, but sorry, I've become very efficient with how I do my analysis. So I do this like clockwork. And then the final part of the prediction process is if price action is likely to go lower to said point, how is it likely to get there? And this is not really a prediction. This is more just like knowledge of the market, because we know that the market can do 3 things, right? The market could continue down. So price would just go straight down to that level. Price can do the hammer dance and go sideways, which means it consolidates before maybe breaking out and going to that level, or price can go up, right? Market does 3 things: down, sideways, up, and up would be a pullback. And that's exactly what we have here. So what I've done with this 4-step process, at least 2 out of the 4 steps, is I have basically created my directional bias, right? I know a lot of traders get confused where they look at a chart and like, Akil, I don't know what to do. Should I get bullish? Should I get bearish? What do I do? And then they go down to different time frames and it gets more confusing because on the higher time frame it said this and then it said that, and they see this and they see that, right? If you follow this process religiously, then you're going to have your trading idea before you ever get to the point where you can even think about trading it. You see, thinking about trading it is what gets a lot of us in trouble because there's so many ways to trade and we get overwhelmed and confused. But what's important is making the right prediction. So in this phase of my trading on my higher time frame personally, all I want to do is create a directional bias. All I want to do is say, Akil, if I were to trade this thing, which direction do I want to trade it in? That's very important in my opinion. Then once I've made up my mind, right, locked in on bearish in this case, then when I go down to my lower time frame, now I look for opportunities that I can get involved in said direction. I'm not even looking at any bullish opportunities unless it's a short-term one on its way to a bearish trade. So we're gonna look at two things right here. One is gonna be a simple price action trade, right? And you can see that price action has started retracing. It started retracing to a previous retracement. How many times can Akil say retracement? And again, I haven't done this analysis yet, so this is going to be kind of fun for me to see. Well, I've done it with my eyeballs, but I haven't actually drawn anything out, so hopefully it works out. But I want to ask myself, okay, what's happening at this retracement? We have a retracement right here. We probably have a 382 Fibonacci in this level, I would guess. Yep, 382 and a 50% right there as well. So we have some Fibonacci confluence there. We have, right, can anyone see what else we have, right? If we're kind of looking at this high compared to this retracement here, you can even take this one here if you want. We have what type of highs? Lower. And if we look at our RSI, we have what type of highs? Higher. Now be ready. I'm going to bring in that weird looking chart again and freak your mind. This is hidden divergence, whether we're looking at it from swing high here to swing high here, or whether you're looking at it from swing high here to swing high here, they're both going to be examples of hidden divergence. Price action is putting in lower highs. RSI is putting in higher highs. It's the weird opposite thing looking on the other side of the chart. This is hidden divergence. This is a good sign for a potential continuation trade. So we're adding that to the mix as well. Next up, if we just take a look at our candlestick, then we got to keep in mind this is the end of the week. So things always kind of like whatever that word is, but peter down. Peter out. To gradually diminish, weaken, or come to a slow end, often starting with high energy but fading to nothing. There we go. Peter out, just like me as I get to the 45-minute point in this video, right? But we do have some interesting signs here, right? If we just take a look at these bullish candles, yes, these are bullish candles. And for you guys that are new, right? I know we typically kind of simplify trading where it's like, okay, red candle, bearish, green candle, bullish. But understand there are levels to these candles, right? Each candle has three distinct levels or three distinct classifications, at least how I teach it, right? There are strong candles, there are weak candles, and there are neutral candles. And we can tell this by comparing the body to the wick and where it completes. So right here would be an example of a strong bullish candle. It's got lots of muscles. It pretty much closes at the high. There's a very teeny tiny wick there, which means price action did spike up a little bit higher, but it pretty much closed at the high. That is a strong, muscular candle. Some call it an Akil candle as well. I'm flexing, but I don't have my camera up, so I'll just kind of give you a visual image of what it looks like if I were on camera. Yeah, you like that. Yeah, you do. Anyway, these candles, you can see there's something a little bit different. While this strong candle had the teeny tiny wick, right? The wicks on these candles are kind of big, right? We have a long wick right here. We have a long wick right here. We have a long wick right here. On this strong candle, we had a close near the very high. On this candle, we have a close kind of in the bottom third, if not the bottom part of the bottom half. Definitely in the bottom half here, in the bottom third there, right? So these are going to be weak candles. And again, that's another way of looking at the market. Where's that word? Petering out, gradually diminishing, weakening, coming to a slow end, right? And just like the ball reference, which I keep telling you about, that's the theme of today's show apparently, it would not surprise me if we saw a little bit of a loss of momentum and we start to roll over. Now, I'm not aggressive enough, you can do whatever the hell you want, to just sell it right? I want to see proof. So a great bit of proof would be a lower low, lower close, right? Preferably a strong lower low, lower close. And that can easily be an entry reason into your bearish continuation trade where you're looking to sell there, stops above the highs here or above the highs here, just give some breathing room. And you can look to trade it back down to either the lows right here or that lower level right there, which is probably also a 127 extension if my eyes see it correctly. Let's take from swing high to swing low. Come on, baby. Oh, sheesh. He's so good. Look at that. Now, that's one way to go about it from a price action perspective. Another way to go about it would be from an advanced pattern formation perspective. If we drop one more time frame down and delete all the junk that I put on the chart, we have what looks like, and I hope, is a cipher pattern here as well. Our X leg is going to start right here at the high. Our A leg is going to be our first swing low right here. So let's draw that in. Swing high to swing low, X to A. I then want to take my Fibonacci retracement tool from the swing high to swing low. Make sure it hits the 382. Ka-ching, check. Now the iffy part, right? My eyes aren't as good at seeing this, but if I take a Fibonacci extension from my swing high of my X to my swing low of my A and back up, I want to make sure this A hits the 127, ka-ching, and B doesn't close below the 1414. Boom. So that does give us a valid C leg, wiping the brow, phew. And if I just steal this fib real quick and draw it to the low, you're going to see that our cipher pattern completes right at our current level. So you have an at market bearish cipher pattern right here. This could be used as a cipher pattern just as its own, as a cipher. Who cares about the other stuff that's going on? This could be used as simply an entry reason into the bigger continuation trade to the downside, or you can do a little bit of both, right? You can kind of split that target up or split that position up in different targets. Maybe a target one takes it out at the cipher target, and then you leave a little bit on just in case you get that bigger move to the downside. Oh, yeah. So another viewer's request that I got comes here on the Euro Yen, where we're putting in a little bit of a reversal. Real quick, just on our theme of divergence here, we've got similar things happening here where price action is losing momentum, but still making higher highs, high 1, high 2, high 3, all higher than the past. And then look at our RSI, we're making high 1, high 2, high 3, all consistently getting lower, divergence. And again, that's a good sign for a regular divergence, is a good sign for a potential reversal. And that's exactly what we did thus far to end the week. We have taken out a previous low right here. And what that does is it allows me to make a prediction that price is likely to go lower. However, this is where things get a little bit difficult because there's lots of structure to the downside that we can go to. The first level that stands out for me is going to be $1.80 right here. You can see this is at the base of that previous flag pattern, pennant pattern, sorry, I'm doing it again, flag pattern right there. That can certainly be a place that the market has a think. Another place that stands out for me is going to be, was it here? Yeah, our previous inside level of structure right here, and you'll see a little bit of a zone above that as well. Not only do we have structure here around, what is this, 175, let's just put it at 175 even for the psychological aspect of it. But we also have kind of after the market gapped up, bloop, right? We have a hold at that level as well. So two levels that really stand out for me. There's another one in here too. Gosh, that would be, you can see why this one's a little bit of a difficult situation. I'll give you three levels right here. I'll give you 180. I will give you $1.78, which is these two levels of structure right here. And then I'll give you $1.75. Those are the three levels that I would expect price to go to. So how do you deal with that? Well, the first one's a little bit tricky because we're right on structure, which makes it a little bit risky. But if you need it to have a reason to trade it, and this is my job to answer these questions for you, what I would say is this. Wait for a fresh break of these lows, right? Price action put in these nice long-legged candles that tested these lows and then wasn't able to stay there. If we can violate those lows, break and close below, that should be a quality sign that we're likely to go lower. Now, the question you'll have to ask yourself is there enough room to go lower if this is my projected target. We're looking at 180.77 to 180 even. Maybe, especially if you're on a lower time frame, that can easily be kind of a break, a retest, and a chance to trade it down. There could be money to had there. Or if you're someone that's interested in the lower zone, then yeah, you've got plenty of room to run there. But that would be my view here on the dollar yen. It's not the greatest opportunity in the world, but really wait for that break and close below to give you any type of confirmation that we're likely to continue lower. There were a few more pairs I want to take a look at, but they weren't all too exciting. So instead of making this an hour-long video, I'm going to let you guys go. Do me a favor, hit that like button before you leave. Make sure you subscribe as well. That way you don't miss all the cool content that I put out on this channel, including all the videos that I put out earlier this week. Also, if you're interested in learning how to trade, check us out, www.tier1trading.com. I recommend that 14-day risk-free trial membership. It gives you access to some courses, to our community, and some live resources as well. And just a reminder that this week I may be moving our Q&A to Tuesday instead of Monday, which means if you are a trial member this week, where you usually don't get access to the Q&A, that's reserved for our premium members, you would actually get to check it out, which is going to be cool. So make sure you check it out. All right, until next time, plan your trade, trade your plan, and I hope you guys have a great weekend.
I want to be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on display.